So I'd like to thank you again for meeting with us today, and I really appreciate you taking the time out of your busy days to talk with us about this audit. The more communication that we have, the more cooperation that we have together, the better this audit will go, the faster we can issue our audit report, you guys can issue your statements. So, like I said, my name is Team1Lee. I'm the lead engagement partner, and I'll have my team introduce themselves again.
And again, I'm Andrew Newton, and I'm a manager in the assurance practice.
I'm Edward Abdul, and I also am a manager in the assurance practice.
I'm Nanku, I'm a senior manager in the assurance department.
And I'm Tom Cook, and I'm an intern on engagement.
So I hope you don't mind, we brought Tom along just because we think it's a great opportunity and a great learning experience for him as an intern, to see an audit committee meeting firsthand.
We'll direct all our questions to him.
Perfect, that's a great idea. He actually did some research on some of the issues we're going to talk about today, so, he could probably answer some of your questions, and maybe he'll talk a little later about some of the things we're going to talk about. So the first thing on the list is the audit committee guidance, and Edward, would you like to talk about that?
Sure. Now, Cordelia, I know that you had mentioned that in regards to the composition of the audit committee, you wanted some feedback. So while I do understand that the assignments right now are only temporary, I'd like to provide you with some factors to consider as you move forward. Feel free to reference Exhibit 1 on the agenda if you'd like to follow along with me.
Yep.
So, per Section 301 of the Sarbanes-Oxley Act, the most important requirement for audit committee members is independence. Now, independence is defined in two ways. Members are barred from receiving direct or indirect compensation except for their participation on the board or board committee. 2, members cannot be affiliated with the company nor hold any officer positions such as CEO, CFO, COO, etc. The audit committee is responsible for overseeing the financial and disclosure process and as well as overseeing the performance of our firm. So it is important that the audit committee members remain independent so that there does not lie a conflict of interest. An independent audit committee will help better align the corporate interests with the interests of the shareholders as well. So, so yeah, they'll have better alignment.
And also, what are we saying as far as I'm concerned? So I understand the rules, based on what you're saying. So are we saying there's a problem?
Unfortunately, Cordelia, yes. Since you are the CEO, you would not be able to, moving forward, you would not be able to serve on the audit committee.
Okay. So it's just me that's the problem?
Kim as well. With Kim, there lies a conflict of interest. She would not be able to serve on the committee because of the revenue that Rock Media does receive from Fox Corporation. So again, these independent requirements, just help to make sure that the audit committee can objectively fulfill their duties.
And also, other than the independent requirement, the Sarbanes-Oxley also highly recommend that we have a financial expert on our audit committee. This expert should be familiar with the GAAP, US GAAP, and its application, should have the experience of dealing with financial statements, and also should be able to understand internal controls and audit committee functions. And even though this expert is not a strict requirement, our Sarbanes-Oxley does require that we disclose why.
You said the expert is not a requirement?
Yeah, it's not a strict requirement, but Sarbanes do require us to disclose why we do not have a financial expert. So this won't be very good in your financial report. So also, it is to our shareholders' benefit to have someone on the committee who actually know about everything, and also will greatly help us to facilitate the communication with us, the external auditor. So that's also something you should consider when being on the audit committee.
So it sounds like we have issues with at least 2 of the 3. Am I okay to serve on the audit committee?
In terms of you, Mr. Milong, we would suggest that you can undergo some training to be more familiar with financial accounting issues. Yes. Yeah, you can. Yes, activities from some education. And this can help you to effectively carry out your duties as a committee member, and also will, most importantly, avoid the disclosure about the lack of financial expert.
So are you saying all members have to be a financial expert?
No.
Okay, so
Yeah,
maybe it's easier, you don't have to undergo training if...
We would recommend it doesn't necessarily have to happen.
Yeah.
And if someone else were to come on, since you cannot, if someone else were to come on who is absolutely a financial expert, then that would fulfill that requirement and you wouldn't have that disclosure.
Okay.
I think it's just better to not have that disclosure for your shareholders, things like that.
Right.
So in the interest of time, I think we should move on to the next item on our agenda, which is your treatment of the recent lawsuit being filed against Fox Corp. So the accounting standards are actually relatively clear about how contingent liabilities like that should be treated, and they state that if the amount of the future loss can be reasonably estimated, and if it's probable that the contingency will occur, then an entry to record the amount of that future loss should be recorded in the current year. Just for your reference, if you want to look at it later on, Exhibit 3 kind of lays out a very simple overview of these FASB requirements on that. So after looking at the letter from your legal counsel, it seems fairly clear that you guys, your situation does fit the requirements of a legal loss that should be booked in the current year. The general business purpose of this regulation is to properly predict the negative impact of future legal losses, so your business can prepare itself for their financial implications. So since your legal counsel did advise that the $500,000 legal loss will probably occur, we really highly recommend you go ahead and book this journal entry to accrue for that now. And I know it may seem difficult, but it really is good business practice behind the regulation.
And I think that might be where the disconnect is, because I think what we're hearing from our management team is that we don't necessarily agree that it's probable that we're going to pay this loss contingency out. So maybe I'm not. There's clearly a disconnect there.
Yes.
How should we resolve this?
Yes, we know you disagree with the legal counsel, but according to the law, the number they provide us, this 500,000 number, is the best estimate we can get so far. So you need to use this number.
So we have to record it.
Yeah, we have to use this number. But the good news is, you still have the chance to reverse it in the future when the trial is actually complete. And also, even the entries we booked this year will not have an impact on our cash flow. So that's definitely the good news.
So why would we reverse it
In
in future periods?
Yeah, in the future, if actually we win the case, but according to the legal counsel, which is not very likely, but what if we win, we will actually reverse the entries.
Well, maybe we'll just regroup with our in-house counsel on it.
Yeah.
And start your position on this.
Yeah, and if you can talk to them and if they can come back with a professional opinion that says that it's not probable, then you don't, according to the rules, have to record it now.
Okay.
But even in worst case, they still say that it's probable and you do have to record it. If you are correct in saying that it probably will end up going your way, in the end, it will be reversed, is what we're trying to say.
Great. So just to keep the meeting moving a little bit, I'd like to talk to you guys about the most recent acquisition you guys had with Bow Wow. So that purchase obviously brought on more assets to your balance sheet, especially goodwill. And you did research on goodwill?
Yes.
So Tom's actually going to talk to you guys a little bit about the research you found on it.
Right, so I know it can be a little intimidating to do goodwill loss impairment research, but I just wanted to give you a brief overview of how we could move forward in accordance with GAAP. So the first step would just be to conduct a qualitative assessment of your goodwill impairment, and some things to keep in mind for that qualitative impairment would be things like losing key personnel in management or changes in industry trends. And if your qualitative assessment indicates that the book value of goodwill is greater than the fair value, then you'll need to record recognize a loss in that period. And GAAP requires that these tests be conducted at the end of each year.
Right, so as you can see, this could be an issue in the future, if there's a loss. But for this year, actually, the impairment will not be recognized just because you acquired the company this year. So we will start testing annually next year for the 2013 audit. Does that make sense? So also...
I'm a little tripped on the qualitative part, because since this is the first time we're kind of inheriting the goodwill account, do you have a good basis to make a qualitative assessment? Or is there a
Because
different way
the
that we should
acquisition-
be testing for goodwill in the future?
Because the acquisition was so recent, there's no indication that the qualitative factors that incorporate goodwill should be affected this year. But going forward, if you were to lose a key member of management, like a CEO or a creative director or something like that, that could affect the impact that the value of the company has. So that would be something qualitatively that you could research to see if it has affected.
Or something like, the recent recession, something like that, like an economic factor, something like that, that could affect the numbers as well. So it's things that are just not really, like the outside factors that are going to affect. So you'll know based on the economy, the news, things like that, and something like a loss of management.
Speak to me a little about, I understand the concept of book value, right? It's what you're going to put on your books, but you mentioned the concept of fair value versus book value, the comparison between the two to determine impairment. what is fair value, how's it determined?
So fair value, what you would do is it'd be very similar to an acquisition. So you would break your business up into separate reporting units. Your corporate finance and accounting department will understand what that means more specifically. And then you'll assess the fair value of each of those, and then compare that again to your book value. And then the difference between those would be the resulting value of your goodwill. And if that is less than the book value that you have, that is when you'll report an impairment.
And technically, just to add on, by fair value, that's the market value. If you were to put it on the market and
Right.
what investors would put the price tag of it on and what you would get, as comparison to your
Right.
book, your
But what you
accounting
think,
records.
Thanks for the clarification.
You're welcome. So just to add on to that, so the acquisition, obviously this year will not have too many extra procedures, but there's other aspects of the acquisition that'll increase our audit work. So could you talk about the increase in the procedures that we're going to do this year?
Yeah, absolutely. So as you know, your recent acquisition of Bow Wow increased your total assets by almost $300 million, which is great. But we have had to do a sizable increase in our audit work over those asset accounts, things like cash, receivables, inventory, etc. In addition, we've had to increase our on-site inventory testing for the 4 added Bow Wow warehouses. And as we pointed out before, the acquisition did add some new accounts to your books that require a little bit extra audit work just kind of by their nebulous nature. And the best example of this is goodwill, as Tom helped us understand before. So as you can see, with this wonderful acquisition comes a necessary increase in the amount of audit work that we have to do to give you guys a clean opinion. So going along with these increased services, we are proposing an increase in your audit fees for the 2012 audit that would reflect these added services that we've had to do between $200,000 and $250,000. I know this seems like a lot, however, we really feel like this is a fair price that truly represents the work that we've done and is beneficial to both.